What credit reports really track in the US? Credit reports play a major role in everyday life in the United States. Yet most people never receive a clear explanation of what they actually contain or how they work. Instead, credit reports are often discussed only when something goes wrong, such as a loan denial, a higher interest rate, or a rejected rental application. By that point, the system already feels intimidating and opaque. One reason credit reports feel confusing is that they are invisible. You cannot see your credit report while going about daily life. It does not arrive in the mail each month, and it does not come with plain language explanations. It exists quietly in the background, influencing decisions made by lenders, landlords, insurers, and sometimes employers, without constant reminders of its presence. Another source of confusion is the way credit information is discussed publicly. Credit reports are often reduced to a single number, commonly referred to as a credit score. While scores are important, they are only summaries. They are built from the contents of the credit report itself. When people focus only on the score, they miss the larger picture of what is being tracked, how long information stays, and how different actions affect the record over time. Many people assume that credit reports track personal behavior in a broad sense, such as how responsible someone is overall or how stable their life appears. In reality, credit reports are far more limited. They track specific financial relationships and events, not character, intentions, or context. Understanding this distinction is essential for interpreting what a credit report does and does not say. This video explains what credit reports actually track in the United States, how that information gets there, and why misunderstandings are so common. It focuses on how the system usually works and avoids worst-case scenarios or fear-based explanations. What a credit report actually is. A credit report is a record of how a person has interacted with certain types of credit and debt over time. It is not a biography, a financial diary, or a comprehensive account of someone's life. It is a data file maintained by credit reporting agencies that collects information reported by lenders and other approved sources. In the United States, credit reports are primarily maintained by three major credit bureaus. These bureaus do not create the information themselves. Instead, they receive data from companies that extend credit or manage debt. These companies choose what to report, when to report it, and how frequently updates are sent. A credit report is organized into sections. Each section serves a specific purpose and tracks a specific type of information. Together, these sections form the basis for credit decisions made by third parties. Importantly, credit reports are not judgments. They are records. They do not explain why something happened, they simply show that it happened. For example, a missed payment is recorded as a missed payment without context about job loss, illness, or emergencies. This lack of context is one of the most important things to understand. Credit reports do not capture the full story behind financial events. They only capture the event itself and the date it occurred. Personal information. What is included and why? The first section of a credit report contains identifying information. This includes a person's name, known variations of that name, date of birth, current and previous addresses, and sometimes employment information. This section exists to help ensure that the credit report is matched to the correct individual. It is not used to evaluate creditworthiness directly. Changes in this section do not raise or lower credit scores on their own. However, errors in identifying information can cause problems. Similar names, shared addresses, or incorrect data can lead to mixed credit files, where information from one person appears on another person's report. These situations often occur silently and are only discovered when a problem arises. It is important to note what this section does not include. It does not list income, savings, investments, or daily spending habits. It does not track marital status, education level, or family background. It exists solely for identification. Many people assume that changing addresses frequently or having multiple jobs negatively affects their credit report. While address changes are recorded, they are not inherently negative. They are simply part of the identifying record, credit accounts. The core of the report. The largest and most important section of a credit report is the account history section. This is where credit relationships are recorded. Each account represents a financial agreement between the individual and a lender or creditor. Accounts can include credit cards, auto loans, mortgages, student loans, personal loans, and other forms of reported credit. Each account entry typically includes the date the account was opened, the credit limit or loan amount, the current balance, and the payment status. Payment history is tracked over time. Reports often show whether payments were made on time, late, or missed entirely. These entries are usually updated monthly, depending on how frequently the creditor reports information. One of the most common misunderstandings is the belief that credit reports track every purchase or transaction. They do not. Credit reports do not list individual purchases, merchants, or items bought. They track only the status of the account itself. For example, if someone uses a credit card to buy groceries, clothing, or fuel, none of those details appear on the credit report. What appears is whether the account balance is managed according to the agreement. Another misconception is that closing an account automatically removes it from the credit report. Closed accounts often remain on the report for years, especially if they were in good standing. Their presence continues to contribute to the overall credit history. Payment history. What is recorded and what is not? Payment history is one of the most influential components of a credit report. It shows whether obligations were met according to the agreed schedule. This includes on-time payments, late payments, and defaults. Late payments are usually reported only after a certain threshold, such as 30 days past due. Payments that are a few days late but brought current before the reporting cycle may not appear at all. This is why some missed payments seem invisible, while others have lasting effects. Once a late payment is reported, it remains on the credit report for a set period of time. During that time, it continues to influence how the report is interpreted by lenders and scoring models. It is important to understand that payment history reflects patterns, not isolated incidents. A single late payment does not define a person's entire credit profile. Over time, consistent on-time behavior has more influence than one past mistake. Credit reports do not track whether payments were difficult to make or required sacrifice. They do not record partial payments unless those payments affect the account status. Again, context is absent. Balances, limits, and utilization. Credit reports track balances and credit limits because these numbers provide insight into how much available credit is being used. This relationship is often referred to as utilization. Utilization does not measure spending habits in a moral sense. It measures how much of the available credit is currently in use. Higher balances relative to limits can signal risk, while lower balances suggest flexibility. Importantly, utilization is a snapshot, not a permanent label. Balances change over time, and credit reports are updated regularly. A high balance one month does not define a credit report forever. Many people assume that carrying a balance is inherently negative. In reality, the report simply reflects the balance. How that balance is interpreted depends on patterns and proportions. Credit reports do not track whether balances were intentional, temporary, or strategic. They simply record the numbers. What credit reports do not track? Understanding what is not tracked is just as important as understanding what is tracked. Credit reports do not include income, bank account balances, cash savings, or investment portfolios. They do not track utility payments unless those payments are sent to collections. They do not track rent payments unless reported through specific programs or related to disputes. They do not track employment performance, education, or professional reputation. They do not track personal relationships or household arrangements. This limited scope is often surprising. Many people assume credit reports are far more comprehensive than they actually are. In reality, they are narrow records focused on specific financial agreements. Why credit reports change over time? Credit reports are not static. They change as new information is reported and old information ages off. Each update reflects a point in time, not a permanent judgment. As accounts age, their influence changes. Older negative entries gradually carry less weight. New positive behavior adds balance to the record. This dynamic nature is often overlooked. People may feel discouraged by past events without realizing that the system is designed to evolve. How negative information actually ends up on a credit report. Negative information does not appear on a credit report suddenly or randomly. It usually follows a predictable sequence of events, even though that sequence may not be obvious while it is happening. Understanding this process helps explain why certain items appear when they do and why others never appear at all. Most negative entries begin with a missed obligation. This could be a missed credit card payment, a skipped loan installment, or an unpaid bill that was originally reported as current. In many cases, the first missed payment does not appear on a credit report immediately. Creditors often wait until an account reaches a certain level of delinquency before reporting it as late. This delay is one reason people are sometimes surprised to see a negative mark appear weeks or even months after the original issue. The reporting cycle operates independently of the moment the payment was missed. When the account reaches a reportable status, the credit report reflects that change. If the account continues to fall behind, additional negative statuses may be reported. These statuses do not overwrite the earlier ones. Instead, they build a pattern over time. The report begins to show not just that a payment was missed, but that the account has remained unresolved. It is important to understand that credit reports do not track intentions or efforts. A person may be actively communicating with a creditor, disputing a charge, or trying to negotiate a payment plan. Unless those efforts result in a formal account update, the report continues to reflect the account status as reported. This is one of the most frustrating aspects of the system. Credit reports move according to data updates, not conversations. Delinquencies, defaults, and status codes explained. When an account becomes overdue, it is typically marked as delinquent. Delinquency is not a single condition. It progresses through stages, often measured in 30-day increments. An account that is 30 days past due may be reported differently than one that is 60 or 90 days past due. Each stage indicates a deeper level of non-payment. These distinctions matter because they influence how the report is interpreted by lenders and scoring systems. If an account remains unpaid long enough, it may be considered in default. Default does not always mean the same thing across different types of credit, but it generally indicates that the original agreement has been broken beyond temporary delay. At this stage, the account may be closed by the creditor, transferred to another department, or prepared for further action. The credit report reflects this change by updating the account's status. One of the most important points to understand is that these status codes are standardized. They are not emotional judgments. They are categories used to describe account conditions in a consistent way. Because they are standardized, they often feel impersonal. The report does not explain why default occurred. It simply records that it did. Collection accounts, what they mean, and how they appear. Collections are among the most misunderstood items on credit reports. Many people assume that a collection account means a lawsuit or aggressive enforcement. In reality, a collection account simply indicates that a debt has been transferred or assigned for collection. This transfer can happen internally within the same company or externally to a separate organization. In either case, the credit report reflects that the original account is no longer being handled as a standard active account. When a debt is placed in collections, a new entry often appears on the credit report. This entry does not replace the original account. Instead, it exists alongside it, creating multiple references to the same underlying obligation. This duplication can be confusing. It may look like two separate debts even though they are related. Credit reports do not always make this relationship clear. Another common misconception is that collections appear immediately after a missed payment. In reality, there is often a long delay. Accounts may go through months of delinquency before being placed in collections. Once a collection account appears, it typically remains on the report for a set period of time. Paying or settling the debt may change how it is listed, but it does not necessarily remove it immediately. Understanding that collections are a reporting category, not a legal judgment, helps demystify their role in credit reports. Charge-offs. What they actually represent. A charge-off is another term that often causes confusion and fear. Many people interpret a charge-off as a cancellation of debt or a final action. In the context of credit reporting, a charge-off is primarily an accounting designation. When a creditor charges off an account, it means they have classified it as unlikely to be collected under the original terms. This classification affects how the creditor reports the account for financial purposes. From a credit report perspective, a charge-off indicates that the account was not repaid as agreed. It does not mean the debt no longer exists. The report reflects the status change, but the underlying obligation may still be pursued or transferred. Charge-offs often remain on credit reports for years. During that time, they continue to influence how the report is interpreted. Like other negative items, they gradually carry less weight as time passes, but they do not disappear quickly. The language surrounding charge-offs can be misleading. The term sounds final, but in practice, it represents a shift in classification rather than a conclusion. How long information stays on a credit report? One of the most common questions people ask about credit reports is how long negative information remains visible. While the exact timelines can vary depending on the type of information, the general principle is consistency. Most negative items remain on credit reports for several years from the date of the original event, not from the last update. This distinction is important. Updating an account does not usually reset the clock. For example, a late payment remains tied to the month it occurred. Subsequent activity does not change that original date. Similarly, collections and charge-offs are anchored to the time the account first became problematic. Positive information also remains on credit reports, often for longer periods. Accounts that were paid on time and closed in good standing can continue to appear for years, contributing to the overall history. The gradual aging of information is built into the system. Older items have less influence than newer ones. This design reflects the idea that recent behavior is more relevant than distant history. Public records. And what is no longer included. In the past, credit reports sometimes included certain public records. Over time, the handling of these records has changed. Today, credit reports are more limited in what they include from public sources. This change has led to confusion, especially among people who remember older reporting practices. It is important to understand that the absence of certain records does not mean they never existed. It means they are no longer part of standard credit reporting. Credit reports are not comprehensive legal histories. They are focused on credit-related information, sequence, fixing, and how errors are handled. Errors can appear on credit reports for many reasons. Similar names, shared addresses, data entry mistakes, or outdated information can all contribute to inaccuracies. Credit reporting systems include mechanisms for disputing and correcting errors. These mechanisms operate through formal processes. Informal explanations or phone conversations do not automatically change what appears on a report. When a dispute is submitted, the reporting agency typically reviews the information with the source that provided it. If the source confirms the data, the report remains unchanged. If the data cannot be verified or is corrected, the report is updated. This process can feel slow and bureaucratic, but it reflects the system's reliance on documented information rather than personal narratives. Why negative items feel more powerful than positive ones? Human attention naturally focuses on negative information. This tendency carries over into how people perceive their credit reports. A single negative item can feel overwhelming, even when surrounded by years of positive history. Credit reports themselves do not prioritize negativity. They simply record information. Interpretation happens externally, through scoring models and decision-making processes. Understanding that the report is a neutral record helps reduce emotional reactions and encourages a more balanced view. How credit reports are actually used in real life. One of the biggest sources of anxiety around credit reports comes from not knowing who sees them and how they are interpreted. Many people imagine their credit report being read line by line, with every mistake magnified and judged. In reality, credit reports are usually reviewed as part of standardized decision-making systems rather than personal evaluations. Lenders, landlords, insurers, and other organizations typically use credit reports to assess risk. This does not mean they are trying to determine whether someone is trustworthy as a person. Instead, they are looking for patterns that suggest how likely a financial agreement is to be repaid as expected. In many cases, the decision maker never sees the full report. Instead, automated systems analyze the data and produce a recommendation. The report provides raw information, and scoring models interpret that information according to predefined criteria. This process explains why credit decisions can feel impersonal or confusing. A denial may occur even when a person feels financially stable, simply because the system flags a pattern that does not meet the criteria for that specific product. Understanding this helps separate emotional reactions from structural realities. Credit reports are tools used by systems, not verdicts on personal worth. Credit scores versus credit reports, why the difference matters. Credit scores and credit reports are closely related, but they are not the same thing. A credit report contains detailed information about accounts, payment history, balances, and public data. A credit score is a numerical summary derived from that information. Many people focus exclusively on their credit score because it is easy to understand and frequently referenced. However, scores can change quickly, sometimes without obvious reasons. Without understanding the underlying report, these changes feel unpredictable. Credit scores are designed to predict risk based on historical data. They weigh different elements of the report according to formulas. Payment history, balances, account age, and credit mix all play roles. Importantly, different scoring models may produce different scores using the same report. This is why a score seen through one service may differ from another. The report remains the same, but the interpretation changes. Focusing only on the score can lead to unnecessary stress. The report itself changes more slowly and provides a clearer picture of long-term trends. How landlords and employers use credit information. Credit reports are not used only by lenders. Landlords often review credit information as part of rental applications. In these cases, the goal is usually to assess payment reliability rather than overall financial health. Landlords may look for patterns such as unpaid debts, recent collections, or frequent late payments. They may not focus on exact balances or account details. Often, the presence or absence of major red flags matters more than perfection. Some employers also review credit information, particularly for roles involving financial responsibility. This practice varies by industry and location. When credit information is used in employment decisions, it is typically considered alongside other factors rather than in isolation. Understanding these uses helps explain why credit reports can influence everyday opportunities beyond borrowing. How to read a credit report calmly and accurately. When reviewing a credit report, many people feel overwhelmed by unfamiliar terms and dense formatting. This reaction is natural. Credit reports are designed for consistency, not clarity. A calm approach involves breaking the report into sections and understanding what each section represents. The identifying information section confirms that the report belongs to the correct individual. Errors here are worth noting, but do not directly affect creditworthiness. The account history section shows relationships with creditors. Rather than focusing on individual missed payments, it is more useful to look for patterns. Are most accounts current? Are negative items isolated or recurring? The collections and negative items sections require careful reading. Understanding dates is critical. Older items generally have less impact than newer ones. Reading a credit report is not about judging past decisions. It is about understanding how information is organized and interpreted. Why credit reports feel punishing even when they are neutral. Many people describe credit reports as punitive. This feeling comes from the consequences associated with negative entries rather than from the reports themselves. Credit reports do not impose penalties. They record events. The penalties come from how other systems respond to those records. Because the effects of negative information can last for years, people often feel trapped by past events. This perception is reinforced by a lack of visibility into how influence changes over time. In reality, the system is designed to weigh recent behavior more heavily than distant history. While negative items remain visible, their influence fades. Understanding this gradual shift can reduce feelings of hopelessness. Why paying off debts does not always remove negative items. A common misconception is that paying a debt automatically removes it from a credit report. In practice, paying a debt changes its status, but it does not erase its history. For example, a collection account that is paid may still appear as a paid collection. The fact that it was once unpaid remains part of the record. This can feel unfair, especially when someone makes an effort to resolve an issue. However, the system is designed to record both the problem and its resolution. Over time, the presence of paid negative items carries less weight than unresolved ones. This distinction matters more than immediate removal. How time changes the impact of credit reports. Time is one of the most powerful factors in credit reporting. As months and years pass, older information becomes less influential. This gradual change is built into scoring models and decision-making processes. It reflects the idea that people's financial behavior evolves. New positive information can balance out older negative entries. Consistent on-time payments gradually reshape the overall profile. Understanding the role of time helps people move away from short-term panic and toward long-term perspective. Why credit reports do not tell the whole story. Credit reports are intentionally limited. They do not explain circumstances, motivations, or personal challenges. They do not reflect income growth, financial education, or improved stability unless those changes affect reported accounts. This limitation is frustrating, but it also prevents subjective judgments. The system relies on standardized data rather than personal narratives. Recognizing this limitation helps explain why credit reports feel incomplete. They are not meant to tell a life story. They are meant to summarize specific financial interactions. How to think about credit reports without fear. Fear often arises from uncertainty. When people do not understand how credit reports work, they imagine worst-case scenarios. A calmer approach involves viewing the report as a snapshot rather than a sentence. It reflects past and present information, not permanent identity. Credit reports change slowly but steadily. They respond to patterns rather than isolated events. This design rewards consistency over perfection. Approaching credit reports with curiosity rather than judgment makes them easier to understand and manage. Common myths that create unnecessary stress. Several myths contribute to anxiety around credit reports. One common belief is that checking your own credit harms it. In reality, reviewing your own report does not negatively affect it. Another myth is that closing accounts always improves credit. In some cases, closing accounts can reduce available credit or shorten account history. Believing these myths can lead to counterproductive decisions. Understanding how the system actually works reduces the likelihood of reacting based on misinformation. Putting credit reports into a long-term context. Credit reports are one part of a broader financial system. They influence access to credit, housing, and sometimes employment, but they are not destiny. Many people experience setbacks that appear on their credit reports and later rebuild without dramatic interventions. The system is designed to allow recovery through time and consistent behavior. Viewing credit reports as evolving records rather than permanent judgments encourages patience and realism. Final calm summary and takeaways. Credit reports track specific financial relationships and events. They do not track character, effort, or intent. They record what happened, not why it happened. Negative information follows structured paths and remains visible for defined periods. Its influence fades over time. Understanding how credit reports are used, interpreted, and updated helps reduce fear and confusion. Knowledge replaces uncertainty. American Rights Guide exists to explain everyday systems in plain English without fear, politics, or hype. If this explanation helped you understand how credit reports really work in the United States, consider subscribing for more calm, educational breakdowns of common systems that affect daily life.